Hey, Similoli here, and in this video, Fibonacci levels tutorial part 1, I'm going to be going over what Fibonacci levels are, how you can use them in your trading, and more importantly, how you can use them to make more consistent profits. Now, as with other indicators, I wouldn't advise that you jump in and begin to use this indicator to trade live as soon as you've learned it. It's important that this method, as with any other method, is mastered before you actually begin live trading with it. Also, subscribe to my channel and hit that bell so you get the second part in this Fibonacci tutorial series. And in this second part, we'll actually be doing some live trading using Fibonacci levels. So with that said and done, let's get right into it. Retracements or pullbacks are short-term price corrections during an overall uptrending or downtrending market. In this diagram, the market is uptrending and the red section just shows that temporary pullback. This is quite normal for the market to take breathers while it continues on its movement upwards or downwards. The opposite is the case in a downtrending market, where the stock takes a breather and rallies before it continues on its downward motion. In an uptrending market, the first thing you need to do is to find a strong upward trend. Secondly, you want to wait for a pullback. You want to enter the trade only after the pullback has occurred. In a downtrending market, the opposite is the case. You want to find a strong downward trend, wait for a rally, and then enter the trade only after the rally has occurred. So the first thing we do once we've identified the swing high and the swing low, we're going to draw our Fibonacci levels. The platform I'm using is THINKORSWIM by TD Ameritrade, and all I have to do is to right-click my mouse, add a drawing, and right there is my Fibonacci tool. So whatever platform you're using, you should be able to find the Fibonacci tools under the indicator tab. I draw my Fibonacci from my swing low to my swing high, and there it is. It is generally known by traders that most moves will retrace around the Fibonacci levels, but specifically around the 50% level. This is why I have highlighted in yellow the 38.2%, 50%, and the 61.8% line. The 61.8% line is acting as support for these 4 candlesticks. And the 38.2% line is acting as resistance. As soon as this candlestick breaks through the 38.2% Fibonacci line, which has been acting as resistance, we see this massive increase in price action to the upside. Setting a stop loss when you enter a trade is always a must. It ensures that you are able to maximize profits as well as mitigate your losses in the event that the market turns against you. In an uptrending market, you want to set your stop loss just below the support level. In the event of a downtrending market, you want to set your stop loss just above the resistance level. In an uptrending market, each of the Fibonacci lines above your entry point can serve as points of resistance. Because of this, you want to set your take profit order on the approach of a resistance line. On the other hand, in a downtrending market, the lines below your entry point would constitute support. So because of the fact that price action can bounce off support, you want to place your take profit order just before the support line. And that's all, folks. I really hope you've gained some merit from watching this video. If you have, the only thing I ask in return is that you hit that like button. I always appreciate your comments and will always do my best to get back to you as soon as I can. Subscribe to my channel if you haven't already, and don't forget to hit that bell. And I'll see you in the next video.